Howdy, Jacob here. Today we're looking at Dorman Products in the automobile components industry. 3.4 billion market cap on 3.8 billion enterprise value. Founded in 1918. They've been around for quite some time. They supply replacement and upgrade parts for passenger cars, light trucks, medium and heavy duty trucks, pretty much a lot of motor vehicles. Their growth in revenue has been very impressive, actually, growing over double in revenue the last 10 years, with their lowest year-over-year growth being 1.8%, greatest being 29% last year. Gross margin has also been very impressive, or not very impressive, I guess. I guess it's gone down. So quite opposite of what I said, but gross margin going down a little bit, operating margin down a little bit. So not as happy that their bottom line is not getting hit as well as their top line, but that is also affecting their return on invested capital because they're making less money on earnings based on the revenue that's coming in. So that's going to be a bummer. Their balance sheet has only 37 million cash on hand with 108 million short-term and 467 million long-term debt. So that 400, let's say 500 million debt in relation to cash flow is about 5 years. Let's say that, if unless this acquisition really bumped up their free cash flow this much, that would be a positive sign, meaning that it'd only be about 2.5 to 3 years of their free cash flow to pay off that debt. Then I'm less concerned about it. So they are paying back a lot of debt. Otherwise, majority of the rest of their money is going to share repurchases outside of those two large net acquisitions. So outside of the debt that they have had recently, majority is going to acquisitions and share repurchases. But again, they do have some debt, and they looks like they will be paying off about half of their free cash flow until it goes away. So to me, a revenue growth of, I'm going to dampen it a little bit since the car market's been absolutely crazy post-COVID. I think I'm going to dampen it down to about 5%. I think they'll definitely get there. I think they'll definitely be able to get down to market average PE, price to free cash flow, due to the fact that margins are going down. I don't like that. Return on invested capital going down. Don't like that. But still a good business from what I'm seeing. Just be conservative with everything here. Let's go 7 and let's go 8 and 7 with share repurchases. 1% would be about 33 million. Let's just say they offset stock-based compensate. Well, 33, 45. That seems pretty reasonable. 45 million to buy back some shares. So this is saying about, a 25% to debt pay down and then split even between 75% of about acquisition reinvestment and then share repurchases. So the company stock price needs to fall 65% before you get the return we're looking for here. We'll be waiting and reviewing other companies in the meantime. Hopefully you enjoy the video and have a great rest of your day.